On behalf of your Baird financial advisor, I'm excited to welcome you to this month's Baird Wealth Strategies webinar. We are joined today by Scott Grenier, Manager of Tax and Estate Planning, Jonathan Raymond, Charitable Solutions Strategist, and Bob Robes, Director of Wealth Strategists. Today, they're going to lead an insightful webinar where we're going to explore the crucial aspects individuals should keep in mind when transferring their wealth. For those of you that are unfamiliar with this team, Scott works with clients and their advisors on business succession, tax, and estate planning strategies, focusing on tax-efficient wealth transfer opportunities. Jonathan provides trust administration and client service, focusing on charitable trusts and charitable organizations. And last but certainly not least, Bob works alongside your Baird financial advisor to develop customized solutions for complex planning needs for high net worth individuals. So before I turn the call over to them, I do have a few housekeeping items that I'd like to highlight. So for optimal viewing, we would suggest setting your layout to the side-by-side view via the circle in the upper right-hand corner of your screen. All participants are in a listen-only mode, but we would love to hear from you. So we will host a Q&A session alongside the panel towards the end of today's presentation and address as many questions as time permits. Just please be sure that when you submit a question, you're submitting it to all panelists. This presentation is being recorded and will be made available along with the slide deck through your Baird financial advisor in about a week. You can also access the slides via a link to the webinar information page, which is linked in the email invitation. So with that, gentlemen, thank you all for joining us today. Scott, I will turn the call over to you and the floor is yours.
Fantastic. Thank you, Justine. And Bob and Jonathan, just want to thank you for being part of this roundtable discussion today. It's great to always be working with you guys side by side as partners as we work with Baird advisors and their clients on a host of different types of outcomes and solutions and conversations, strategies, engagements. It's a fantastic opportunity for me to be here and to be working side by side with you guys. So thank you. For today, we're going to walk through, and as you can see for the agenda, we're going to cover an overview of the federal estate tax laws. What is bringing us for this conversation today? What is going on in the tax world that has so many people questioning wealth transfer conversations? So we'll cover where we are with the estate tax laws. We'll discuss the potential impact to various families and individuals and where you might as an individual fall in that range for you and your family. But most importantly, we're then going to shift to a Q&A roundtable discussion with myself, Bob, and Jonathan, whereby we will have a series of questions, and then as a panel, we will look to answer those questions and also answer many of the questions that you have as well. So with that, we'll continue on here on the agenda and talk about the federal estate tax system and where we are. The current federal estate tax system. So, right, what we're basing this off of is the amount of assets that an individual or married couple can transfer to individuals without paying an estate tax. And when we think about this tax, as you can see in the third to the right column, the marginal estate tax here is a 40% tax rate on everything that is over the federal estate tax exemption amount. Now, this exemption amount is something that has changed numerous times over the past 24 years since the creation of the Economic Growth Tax Relief and Reconciliation Act back in 2000. We've seen some major tax law changes, including one in 2017 that became effective in 2018, known as the Tax Cuts and Jobs Act of 2018. And when this was signed in late 2017, what we noticed is that part of the tax law change was to increase the federal estate tax exemption from roughly $5.5 million to a little over $11 million per person, which meant that at the time a married couple would have an exemption that would exceed $22 million at that point in time. And again, $11,180,000 for an individual. These numbers were inflation adjusted from 2018 through where we are today in 2024 with a federal estate tax exemption of $13.61 million. Which means even those individuals that may have gifted their $11,180,000 in 2018 still have an additional $2 million, almost $2,500,000 of additional exemption that they can use between now and the potential sunsetting of the estate tax laws. In addition, so we look at where these exemptions are today. We're at this 13.61 million exemption. We have a projected number for 2025. I would not get too hung up on that. That is just a projected number. It's likely to be slightly different than that, but we are anticipating that the federal estate tax exemption will be somewhere near $14 million going into 2025. But you'll also notice at the very bottom in the yellow is the projected change in the federal estate tax exemption amount from this roughly 14 million to somewhere near $7 million. Right? This is the sunsetting of the Tax Cuts and Jobs Act of 2018 that'll sunset on December 31st and come of 2025, and come January 1 of 2026, we will revert back to the old tax laws that we had in place, which will take us back to where that 5.49 million exemption from 2017 existed. And it will be inflation adjusted to be somewhere around this $7 million figure. This sunsetting of the Tax Cuts and Jobs Act is why so many individuals are looking at wealth transfer strategies between now and the end of 2025 to determine how to effectively transfer wealth to individuals and or charitable causes prior to a potential change in these tax laws. For some, it may mean you don't need to do anything. For others, there's certainly some things you may want to do. So let's take a look at this in a picture format, right? Individual has a 13.61 million exemption with a 27.2 million exemption for a married couple. Again, estimating the inflation adjustments out, we see that an individual will have over 14 million exemption and a married couple would be north of 28 million of an exemption. Come 2026, if we do not sunset, if the tax laws should be extended, again, we would anticipate an inflation adjusted increase of the exemption, and we would expect that the individual exemption would be somewhere around 15 million and a married couple may be somewhere around 30 million. The challenge, though, that we've highlighted is with sunset of the Tax Cuts and Jobs Act, we are anticipating that the exemption for a single individual will fall all the way down to 7 million per person. And for a married couple, it'll go down to 14 million. The significance here is if you look at the difference between where we are today, let's just use roughly 28 million of an exemption versus where it goes down to 14 million for a married couple. That is a reduction of 14 million of exemption for that married couple come 2026. If you multiply that by a 40% tax rate, we're looking at over a $5 million increase in estate taxes for a family that could otherwise be subject to this tax. So what many of our clients want to know then is what do we need to consider doing in light of the Tax Cuts and Jobs Act sunset? So let's use how this actually works and apply the math puzzle to these tax laws. So here what we're looking at is a situation in which we have a current estate tax exemption of just under $14 million, right, for this individual. The individual would like to transfer $8 million today, prior to the change in the tax laws, to use up this $8 million amount that is going to be sunsetting. They want to keep the other $7 million exemption on the back end once it changes, and they can make gifts later on in that scenario. However, that's actually not how the IRS applies the math formula. We oftentimes think about subtracting from the exemption of where you are today, minus the gifts that you made to come out with your remaining exemption. Unfortunately, the way the IRS actually works with this is if you were to make an $8 million gift today as an individual, you use up from your bottom counting up, not top counting down. And when you do that, if you were to make an $8 million gift today, you will see that you will actually lose that 7 million exemption in the future. If you made a $10 million gift today, you would lose 5 million of your exemption from the sunset. And basically what we're trying to display here for you is two concepts. Number one, in order to take advantage of the higher exemption that's here today, you must make gifts that will exceed what the federal exemption will become in the future. Otherwise, if I were to just give 7 million today as an individual, and come sunset, I will have no exemption remaining, as the IRS will simply just say, I've used up my $7 million of gifting. All of that higher exemption amount that was available would then be lost. So the only way for me to benefit from this higher exemption is to actually use an exemption amount that is greater than what the exemption will be in the future. If I don't fully utilize that exemption, then I will lose a portion of that exemption when it sunsets. So if you see in the far right column here, we have a $15 million gift made now. And in that example, there's no lost exemption for that client. They fully utilize the exemption that's available, which again, today in 2024 is 13.61 million. And they fully utilize their exemption today, and they're grandfathered in under these rules. But if I take a step back and I just make a $12 million gift today, well, I'm going to lose some of that exemption when it sunsets. And if I only make a $10 million gift, I'm going to lose even more. And if I make an $8 million gift, I'm losing a lot more. So the key here is to understand we want to grandfather clients into the current exemptions by fully utilizing, if we can, your current exemptions, knowing that we're counting from bottom up, not going top down. So who are the impacted families and individuals? First, let's start with the simple. For married couples with 30 million or more today, they are already subject to the estate tax. They're above their 27.22 million exemption already. Come sunset, that estate tax will continue to grow for that particular household. These clients that are worth 30 million or more should already be working with their Baird advisor as their trusted advisor and their outside resources, such as their CPA and estate planning attorney. And the reason for that is something we're going to discuss later, which is it takes time. It takes time to plan. It takes time to execute. And most importantly for our client, it takes time to make informed decisions and to gain confidence in the decisions you're making. The next subset of clients that potentially are going to be impacted by the Tax Cuts and Jobs Act are clients who are worth 14 million to 30 million today. Think about a married couple today that is worth, let's say, 20 million. Currently, they do not have an estate tax liability. The current exemption is 27.22 million, and they're worth only 20 only. And in this example, they are not subject to the estate tax. But if the Tax Cuts and Jobs Act sunsets in January 1 of 2026, and that exemption goes from near 30 million at the time, down to 14 million combined, 7 million per spouse. All of a sudden, those clients, and in this particular example, this $20 million client will be subject to an estate tax liability. Now, there are ways to minimize or mitigate this tax, which we'll talk about later on today as well. But we see in this scenario, we go from a client with no tax liability, estate tax liability today, to January 1, 2026, all of a sudden, they now have an estate tax liability. And then we have our third subset of clients. Our third subset of clients are clients who are currently below $14 million as a married couple. So let's think about this as maybe a $10 million client relationship, married couple with $10 million. In that scenario, right, and this represents 99% of our population in the United States, of all households in the US. In this scenario, though, if I have a married couple worth 10 million, even if the laws sunset, they would not be subject to the estate tax. However, these individuals might also have a significant increase in their wealth over time through their own creation of wealth and or the receipt of wealth through in gifting from generations above them and or through an inheritance upon the death of the generations above them. And in that scenario, we could easily see a client who is not subject to the tax today, who would not be subject to the tax on January 1 of 2026, but may have an estate tax in the future based off of the wealth that they've created and or received. And so our conversation today is going to be a little bit about how to manage and work through the conversations of the estate tax laws, but we also know that there's a broader conversation to have here. And that broader conversation sometimes is not as much quantitative as it can be qualitative. With that, I'll just kind of highlight working with Baird advisors and the Baird advisors' access to resources here within Baird. We have a very large team of wealth planning professionals that work very closely together, such as Bob and Jonathan and I work together weekly for clients to determine strategies and opportunities and engaging with our Baird advisors. And we have a host of different roles and responsibilities within our team structure that allow us to serve our Baird advisors and their clients based off of the needs of our Baird clients. Our role is to work with our Baird advisors and their clients as an independent party that can help educate our clients and help inform them in the decisions that they are looking to make. We don't draft estate planning documents. We don't create private foundations. We don't we don't perform tax returns, but we can help be that coordinator between your other trusted advisors. And that is our central role, is to work with you and your Baird advisor to help to identify the strategies that best meet your needs. It allows us to be independent and to ensure that when you're working with us, that you can have the complete confidence to know that we are always looking out for your best interest. With that, Justine, that's an overview of where we are for the tax laws today. I'm going to turn it over to you for our panel discussion.
Great. Thank you so much for your expertise here, Scott. Before I jump into some of these panel questions, I'm just going to remind the audience, this is now the time. If you want to ask some questions throughout, I'll make sure to pepper them over to our panel. You can do so by clicking on that Q&A icon on the bottom right-hand side of your screen. Again, just be sure to address your questions to all panelists, please. Awesome. So with that, Scott, I know that you just talked through, all of this estate tax exemption. A lot is being made out about it. Would you go into a little bit, you talked about it, but do I really need to worry about this? And if so, how early should I really start planning for it?
Yeah, great question, Justine. And, listen, I think we tried to identify the subset of families and who might otherwise be subject to the tax and not. The reality is planning is needed regardless of whether there's an estate tax or not, right? We talk about the qualitative aspects of planning, which is to ensure you have a comprehensive estate plan, estate and wealth transfer plan in place. Whereby there are named individuals, they understand their roles and responsibilities. There's a discussion over family values and goals. We want to talk about family history to ensure it's not lost upon the next generation, and make sure that the next generation truly understands the expectations of what that wealth transfer looks like. But if you are potentially subject to the estate tax liability as a result of either your net worth today and where the exemptions are, or a change of the exemptions through the Tax Cuts and Jobs Act sunsetting, then yes, you should be working with your Baird advisor today. There's a host of information that your Baird advisor would need to know. And certainly we want to start to think about the strategies that might be available and work with those outside professionals and give you more time to decide what is best for you and your family. What we don't want is to wait till the very end of December of 2025 and try to get in front of the estate planning attorney to draft the strategies and execute the strategies, which may not be feasible. And secondly, it doesn't give our clients the most amount of time to make that informed decision. Things will be rushed, and there won't be that degree of confidence that we otherwise want our clients to feel and have when they're making these decisions.
Bob or Jonathan, anything to add?
Yeah, thank you, Justine. So, Scott, you've said, and that was a great summary that you provided. I think something that's important to remember is that this sunset is happening unless there's a change in the law. I mean, that's something that's really important. And just to alleviate any confusion around that, under current law, what Scott laid out is what is going to happen. And so it's really important to keep that in mind as you're thinking about your planning. The other part I want to go back to what Scott said is, who should be thinking about this. And it's not those who only have a net worth of at least 7 if you're single or 14 if you're married today, but who's going to project into that space. You start thinking about just the type of prudent wealth transfer and estate planning one should do. It should be sort of agnostic as to the sunset. So if you're someone who is an investor, if you're a business owner, and you're projecting your wealth to grow into the 10 plus, 20 plus million net worth space, you might want to do some planning now to get that appreciation outside of your estate. So it's not something that you're facing in 2026, 27, 28. And the reason it's important to think about it now is, let's say that your net worth is $20 million, and you think, okay, we're going to do a $10 million wealth transfer. Maybe we'll do a $12 million wealth transfer. Very often, historically, there would be a transfer made, and that gift would be split between spouses, and each one would make a $5 or $6 million gift. Well, if you do that today and the sunset occurs, now if you go to that scenario that Scott laid out where it comes off the bottom, now each of you have lost a significant portion of your estate tax exemption. Whereas if we're intentional in thinking about how to structure that, maybe utilizing the exemption of just one spouse and doubling that up so that when the sunset occurs under current law, now we're only losing a small part of the exemption of one spouse and then that chunk from the second spouse. But you've been really intentional and thoughtful in how that works. The other part I want to go to what Scott said is, when should you start? So we saw a scenario like this, an environment like this in 2011 and 2012. And as someone who was practicing then, our capacity was just strained starting in 2011. And you really want to make sure that you're not the one that gets stuck in the queue and whose work either gets rushed at the end or doesn't get done at all. And so starting those conversations with your Baird advisor now, having your Baird advisor then bring in that wealth planning team that Scott talked about is really important today. And then as far as the intentionality around it, there's also the charitable aspect that Scott talked about in weaving philanthropy into your planning today. So Jonathan, would be interested to hear your thoughts around that.
I appreciate all these comments and everything that both Scott and Bob have talked about today. These are to the best of our knowledge. There is some uncertainty. It's possible that exemption levels go down. They could say that they could sunset. They could even increase. There's possibility there, but this is to the best of our knowledge. We do know that they're scheduled to sunset. So I would really broaden all of the comments that both Scott and Bob made to say, a big portion of what we're talking about here with wealth transfer and trying to figure out what is the most effective way for you and your advisors to work together is to examine what your goals are. And for a lot of clients, that also involves goals of providing for charities that you've supported during your lives, making sure that you've got a legacy, that you're making sure that those values that are important to you continue to show through. And so that's where we really encourage you to start having some of those conversations. And we might be able to figure out, we'll be able to figure out what is the best step to accomplish that, regardless of the uncertainty of what laws might be or what your future wealth growth might be. Again, those are uncertainties out there. We can only prepare with the knowledge we have, but a key portion of that knowledge is the goals that you know. And so being able to examine that and have a frank discussion is quite frankly going to be beneficial to everyone involved, to you, your children, families as a whole. So encourage you to do that.
Awesome, thank you. I'm gonna pop over to our next panelist question, but then I might head to the audience. There are quite a few coming into the queue. So how can we continue to support causes that are important to us after we pass? And what assurance do I have that our intent, both of our family and causes important to us, will continue and that our memory lives on?
I think this question is probably most geared towards me, so I'll be glad to start on that one. My number one suggestion is to use some of the effective tax strategy and planning that we were talking about here, but don't let those tax strategies dictate. And so it gets back to maybe my previous comment there, is that it's very easy to lose the forest for the trees when we're involved there, that we're so focused on that tax saving that we really lose the perspective of what we're trying to accomplish. So I always recommend that the starting point is not necessarily, what is your tax return look like this year, but to have an honest, open discussion with your Baird advisor of what your goals are. And maybe even step back and say, look, I don't know what the tax laws are. I don't know what the strategies are. Can we describe what the ideal outcome would be? If you had no other restrictions, what would you like to see for your family? What would you like to see for the causes that you care about? Now, the good thing here is charitably, the government does actually provide a lot of incentives for us to be able to support the causes, the common good through philanthropy. And there are many vehicles that are out there, all of which have various tax benefits to them. Again, rewarding us for being able to support those causes. Shockingly, though, although the overwhelming majority of Americans donate to causes they care about every single year, and they do this through donations, they do this through volunteer work. When we look at the statistics, only about 6% of all individuals actually include some sort of charitable gift as part of their estate plan. And given just the sheer number of people who donate and give back on an annual basis, we really think that's because they haven't spent the time to ask some of those questions to incorporate that in, because clearly the support of those organizations has been important to them through their lives. And usually we would expect that individuals would want to continue some of that support even after death. So there are great options out there, whether that be donor advised fund, family foundations, charitable remainder trust that can give income streams, charitable lead trust that can provide growth outside of your taxable estate, just to name a few. So what I always find very exciting is to be able to figure out how to organize and involve that next generation in giving and to really have those conversations. But it all starts with an honest discussion of what your ideal outcomes and goals are.
Awesome. Thank you, Jonathan. I have a couple maybe more technical questions coming in from the audience that, Scott, I might just ask you to clarify on a couple, and then we'll go back to some panel questions as well. But for the annual tax-free gifting limits, is it 18,000 per, let's say, individual to individual, or is it 18,000 per household to household?
Yeah, great question. This is an 18,000 per person. So I, as an individual, can give $18,000 to any individual I want, whether I'm related or not related to those individuals. The IRS considers this to be a de minimis amount and is meant to incorporate all gifts that I would otherwise make to that individual. In other words, birthdays, holidays, graduation gifts, those all fall under this de minimis $18,000 amount. So to the extent that you are looking to make a gift up to the annual exclusion, you should otherwise reduce that amount by your planned other gifts you plan to make to those individuals throughout the year.
Awesome, thank you. And what if assets held by a couple are not held jointly and the couple's net worth is not equal? How does this affect the lifetime exemption for couples if the one with the higher net worth dies first or vice versa? Any recommendations there?
Yeah, and Bob, I'll have you add on to this coming up after, but I'll just start by saying it's not uncommon for us to work with individuals who have an unequalized estate, right? due to the potential earnings of one spouse over another, or gifts or inheritances that one spouse may have received over the other. So it's very common in our industry for us to work with clients that have unequalized size of the estates. Sometimes there is some estate equalization that we might look to do by making an unlimited gift to our spouse where there's not the use of exemption. Sometimes we make those unlimited gifts to our spouses through irrevocable trust, either during lifetime or at death. Or we might give the assets outright to our spouse to try to equalize those assets. Historically, we do that more, I'd say, at the state level for state estate tax purposes, but it can also be done at the federal level. And there are vehicles that, upon the higher net worth spouse's passing, that would allow you to still avoid the estate tax at the first spouse's death and allow for a portion of those assets to be included in the lower net worth surviving spouse's estate when the surviving spouse should pass, so that there's no estate tax when the first spouse dies, and you potentially reduce the estate tax that will be owed and or minimize it or mitigate it entirely when the surviving spouse should pass.
Yeah, Justine, just further to Scott's point, it used to be that equalization was important, much more important than it is today. There was a change in the law, I think 2011, when a concept called portability was introduced, where you didn't necessarily have to worry about equalizing the estates, but it still is important to analyze it because we focus on the estate tax, but there's this other tax out there called the generation skipping transfer tax, which is not portable from the surviving spouse, from the deceased spouse to the surviving spouse. So it requires intentional planning. So to Scott's point, though, there's a number of techniques that can be used so that the tax ramifications are reduced. That marital trust concept is one we see all the time, so that any estate tax that may be due, regardless of the equality or inequality of the spouse's estates, is pushed to the second spouse to pass. So it is important, though, to have those conversations. Asset titling is really important, and sometimes we focus on the aggregate, and we need to zoom in a little bit and see how assets are held to ensure that, for example, they even pass according to someone's wishes, right? So when you start thinking about assets that pass according by operation of law, or you start thinking about these other agreements that a spouse may have made, say they're co-owners in a business and there's a buy-sell agreement, and the agreement that you would enter into says one thing, but your estate plan says something else. That agreement you entered into with another party controls the outcome. And so it is important to, regardless of even the assets that are held between spouses, to dig a little deeper and see how those assets are held and what other agreements have been made as it pertains to the assets owned by each spouse.
And it is always good to have these conversations. We're very thankful for the addition of that portability election, but be aware that that's something that can be lost when the surviving spouse may get remarried. So again, really having a good examination of that and a good discussion of what does that mean, especially if a death might occur at a much younger age when remarriage might be much more likely.
Awesome. Thank you all. I'm going to pop back to my next panel question because there's some questions that I think pertain to this next one. But what are some ways that we can set up our children for success aside from just leaving them assets outright?
So, Justine, a tried and true way is through the utilization of trusts. And it's really important to understand that at its core, a trust is a contract, it's an agreement, and there's broad flexibility as to what trusts can say. And so those goals and values that are important can be instilled in those documents and carried forward. But you start thinking then about what does that trust, what are the important concepts in that trust, right? And so you start thinking about distributions, how my family is going to benefit from the wealth that I leave them. Do I want it to stay in a trust so that it's protected from the outside world, for example, in the event of a divorce or a judgment against one of my family members? Or do I want them to receive it outright and just give it to them at all at once or in stages? Very often we see, a third at age 30, half the balance at 35, and then outright at 40. I'll say I used to see 25, 30, and 35, and as the parent of a 24-year-old, I do not think that 25 is a good place to start. But let's say that the decision is, we want to keep it within a trust so that we're enabling our children to go have their productive lives and not encourage them to live off of the trust. So you start thinking about then who is in control of the trust assets. Trustee selection is really important. Who that trusted person or institution is that is going to make those hard decisions to ensure that the goals and values that I've set forth in, throughout raising my family and but I want carried forward after I'm gone, that those are continuously maintained. And that's where having a relationship with an institution makes a lot of sense. And working with Baird Trust and the work that our trust company does, and really getting to understand families, understanding the goals and objectives and values of the person who sets up the trust, understanding the beneficiaries, getting to know the family, developing that important relationship at that next generation. We invest a lot of time in the construction of these plans, and then Baird Trust invests even more in making sure that they're administered properly. And Jonathan, with when you think also about bringing in the that goals and values, you mentioned before the importance of those family conversations to set those expectations. Just maybe share a little more about that.
Yeah, we always encourage families to meet family generations kind of where they're at. And so it might be giving some autonomy of younger generations to be able to have some control, to start to develop, to start to hear the stories of how the family earned their money, how the family can continue to support each other. A couple comments that I was thinking of as you were going through this is this question is dealing specifically with children, but expanding it out. It's not just our children, it's grandchildren, it's great-grandchildren, and great vehicles, whether it be an educational trust or whether it be 529 plans, all those type options that can support future generations beyond just, again, giving our immediate children assets outright. One other thing that in the philanthropic space that I work with families a lot is working with family foundations, especially if we're talking about individuals that might be at that estate tax limitation, being able to give what we can to our children, but then some excess funds going into a foundation that your children, your grandchildren, great-grandchildren down the road are going to be able to help administer and award out grants in the community. That guarantees that they are always going to be part of the discussion, that active participation in their community, and is going to set them up for success beyond just their own personal assets, but being able to really be leaders in their community.
Awesome.
Yeah, Jonathan, I think you got it right. We focus so much time and effort on the family values, the family stories, and making sure that that history is not lost. Because there's just too many times where older generations kept too much to themselves, and the failure to communicate the plan created a lot of anxiety for families, right? It might have transferred wealth inappropriately and has been lost due to different circumstances. And for us to be able to take that time and sit down and truly understand the client's goals and values and expectations, that family history, and help them convey those messages back to their own family is truly worth more than anything else that we can probably do from a strategy perspective in working with our clients. And so, I often, again, when we talk about this independent view here at Baird that we have in working with our advisors and their clients, we also realize that there's not just a single solution. Right? I'm very fond of giving clients a range of outcomes or a spectrum to say, you can give it all outright to your kids. You can give it all in a trust for your kids. And then there's hybrid solutions, which is anything in between. You might decide to do a combination of them. Maybe the children should receive some portion outright so that maybe they're not beholden to the trustee, or they can do what they want with a portion of the assets. And then the other portion is saved into an irrevocable trust for greater asset protection. We never know what's going to happen in our children's lifetimes, what their relationships might be. What they look like today may not be what they are tomorrow. We don't know what type of creditor risk they might face or bankruptcy risk they might face. And so planning oftentimes is not just a single solution or a single strategy, but rather a hybrid between multiple strategies that conform to the client's goals, wishes, and expectations. And then it's our job and responsibility to help the client communicate what that looks like so that the heirs truly understand how the wealth transfer will occur and what the expectations of the use of those funds should be for not only that individual, but for their heirs and in the community, instead of just looking at it as winning the proverbial lottery.
Awesome. We have a couple questions coming in from business owners, so I'm going to go to our next panel questions that I think pertain to them. If my children aren't interested in continuing with the family business, what are some exit strategies to help with an effective transition? Is Baird able to help with the planning for this? Also, how far in advance should I talk to my Baird advisor about plans for my business? And what if I do not know what to do?
Justine, I'll kick off this one, and there's a lot here. And so, when you start thinking about, and I'll just kind of go in order of the questions here. So some exit strategies, you start thinking about if your children are not interested in continuing the family business, then you start thinking about selling it, right? And so there's the option to sell it to somebody who's in a similar line of business through a strategic sale. Sometimes there's an opportunity to sell to a financial buyer. That's where you hear about like private equity. And those are a little different, right? If somebody's coming in to buy your business, and because they're going to fold it into their own, more often than not, it's you're selling it, and they're going to fold what you've built into what they are building. Whereas if you have a financial buyer, a private equity buyer, they're buying you as part of the business and your management team, and they're looking to grow it with you. And so the expectation is that you'd stay involved for a little bit longer and take some cash up front, but then participate in that proverbial second bite of the apple when the private equity firm is ready to sell it. But there's also internal opportunities, right? I mean, you may have some key executives who would love to take over the business, and you could structure a sale to them. Probably wouldn't get paid as much in doing so, but there would be the opportunity there. A lot of times that requires you to sell it on an installment basis, and so you may get paid over time instead of a lump sum up front, but it's a great way if you're looking to keep that business going, the culture you've built with some key executives, and reward them for their years of hard work. And then very often we hear about an ESOP as another opportunity to sell to the employees. It's something that people often talk about and less often execute because you have to really meet a certain set of parameters, whether it's revenue size, net worth size, or employee size, or employee base to make those work. So absolutely, there's options, and Baird is well versed in helping plan for that. We have a team that is available to our business owner clients through their Baird advisor. It's called our Business Owner Solutions Group, and they are incredibly have an incredible depth of knowledge in helping you as a business owner think through where you are with your business at any stage of your business ownership. So how far in advance? I would suggest that at the end of the call today, you shoot an email or a phone call to your Baird advisor and say, look, I'd be really interested to have a conversation around my business, the plans for my business, and invite a call with our Business Owner Solutions team. And the other part that's really important to understand is, Scott and Jonathan have been talking about how we're able to bring all of these resources together. It is really been a wonderful experience here at Baird. I've actually been at Baird for less than a year to see how seamless these pieces fit. I interact with our Business Owner Solutions team multiple times a week because it's important for our business owner clients to have a comprehensive plan that incorporates the plans for their business, the operation of the business, what's going to happen to that business, but also on the personal side, it's an asset that is owned by you, the business owner. Oftentimes it is the single largest asset you own. And so in incorporating your planning, it's very important to make sure that those pieces fit. And then lastly, if you don't know what to do, we're happy to just help think through the various options that are available to you. It's a lot of times you've been so busy just building this business and it's become very successful, and you're in the now what stage, and we certainly, together with our Business Owner Solutions team, can help work through that.
A common conversation that I end up having here, whether it's a family business or any really concentrated low basis asset that someone has, which might be a family farm. There might not be the next generation that's able to farm that, whether it's real estate or even if it's some large concentration of company stock at retirement. And in all these cases, there's this real reluctance or hesitancy to sell that concentrated asset because they realize that they're going to be hit with a large tax hit up front from the capital gain from that asset. So a charitable remainder trust is a potential solution that I talk and work with both Scott and Bob quite frequently on. We're able to defer a lot of that recognition of that gain until that income stream comes back to the seller of the family business or those other concentrated assets. And really that deferral is a key piece of that, in addition to being able to get a charitable deduction up front. So again, being able to fold that in as part of that business succession planning can be huge. The big timing issue here is a lot of times hear about this a little too late. It has to be done with time while both parties, whether that's that private equity, whether that's those key executives in the business that Bob talked about, it has to be done when really all sides could walk away. So before terms are actually settled on, I need to explore some of those opportunities. So the earlier, the better. And your Baird advisor is always glad to incorporate that into that planning discussion for you.
And Jonathan, as we talk about whether it's the charitable side or even just the transfer to individuals, and I know one of the questions we received, Justine, was related to valuation of a business, the timeline, potential cost, and then discounted gifting techniques. And certainly businesses offer a tremendous opportunity when it comes to wealth transfer, just based off of going and getting that qualified appraisal of the company, which is going to cost a good stream of money and time as well to get that qualified appraisal completed. And one thing that Bob and Jonathan and I always talk about with Baird advisors and clients is the time to start is now, right? To start the conversation. It doesn't mean you need to take an action today per se, You don't need to necessarily execute and transfer wealth today, but we need to build the conversation. We need to understand the underpinnings of your net worth and the type of assets and the construction of your company and who you want to potentially run the company in the future, and how is the business value today and what might it get sold for? Are you anticipating potentially selling, and when might that occur? And are there discounted tools and techniques we could use depending on what you might need as the business owner out of a potential sale or from the income stream? If we start gifting away assets to the kids at the next generation, but you've been using that business income stream to fund your lifestyle, and all of a sudden on a pro rata basis, that income stream is reduced by what you've given to the kids because now the kids are getting that income stream. Are you still able to finance the lifestyle that you want for yourself today and in the future? And the same thing goes for a sale. How much of the sale proceeds might you actually need to fund your lifestyle in retirement? And have you done that calculation? Because we won't want to look at wealth transfer strategies to the next generation if we haven't ensured that your financial independence has been taken care of and thoughtfully prepared through a financial plan that is holistic in nature and contemplates various different scenarios for you and potentially your spouse before we start worrying too much about the kids.
And Scott, you mentioned valuations, and you know you're right. You know, getting a valuation is going to cost a decent amount of money. One thing that your Baird advisor can bring you, though, is a range of value estimate that our business owner solutions team will prepare. And it's not a valuation you can rely upon when implementing a wealth transfer plan. You really do need a full valuation that meets the definitions that's in the tax code, that's incorporated into a gift tax return. But we find that a lot of our business owners get a lot of value by just getting a range of value estimate from our business owner solutions team, because it helps frame planning conversations. And so, if that's something also that would be of interest to you as you're thinking through your wealth transfer planning, and especially in light of the impending sunset, feel free to reach out to your Baird advisor and inquire about a range of value estimate that can be provided in order to enhance the planning conversations around your business.
Great, thank you. We've been talking quite a bit about children, so I'm going to stay in that theme. Is there a way to allow my children to materially participate in meetings so that they can build confidence with the process? And if yes, how soon would you recommend I start bringing my children into the financial conversations to make sure that the conversations don't happen too late?
I'll keep my answer pretty short on this one, but the earlier the better. Again, we're all at different stages in our financial and philanthropic journey. So again, meeting our children where they are at that moment, I think is always important, and it sets them up for being able to take tidbits and be able to expand on that. It's always easier to build when there's that foundation, and that foundation is going to start small, but building upon it, as opposed to all of a sudden being, winning again that proverbial lottery there. One example that I always hear and I love sharing is really kind of a 3-bucket type of approach is when we're entrusting our children is to give a third that's with the idea to save, a third that's with the idea to give, and then a third that they can spend. And again, that sets that expectation, gives some autonomy, lets them see what that ultimately means, and makes it real for them.
Yeah, Jonathan, I like that a third concept. It works really well. When I'm oftentimes working with our Baird advisors and families during family meetings, I think what's important to understand is there's not necessarily a single technique or solution here as well, right? And the style in which you decide to inform your family of how your estate and wealth transfer plan is designed, whether it includes philanthropic interest, whether it's trust, whether it's giving assets outright or in trust for the beneficiaries. I always recommend, to Jonathan's point, start early, but make sure it's often, early and often, right? let's make sure that you're conveying to your children material changes that might be happening in your estate plan, right? And oftentimes this could just start with a simple, here's how we designed our plan, or here's your role and responsibility. You are serving as a successor healthcare power of attorney agent. What does a healthcare power of attorney agent do? What are some of the decisions you might be involved in making? And what do we want you to know about our own health status while you're making those decisions? Same thing for financial power of attorney, or we look at trustees or personal representatives. Sometimes we'll hear from the kids that they want a little bit less involvement. They don't want to take on that responsibility. And that's a great opportunity for then the generation one to know, I need to alter my plan because my heirs, my children, aren't comfortable potentially serving in the role that I may have named them in, right? Maybe that's where, again, we already have a default with a Baird trust as a backup, or maybe we want to insert and or move Baird trust up the line in that family relationship. And those conversations can help us strategize with you as the client to determine where do you go next. And then lastly, I'll say this is, you don't always have to necessarily bring in the finances into the equation, right? We can start the conversation with the family of family values, history, goals, expectations, and how the plan is designed and why it's designed the way it is, without necessarily having to tell the kids of your net worth today or what they should potentially expect to receive as an inheritance, which again, in doing so, might change their view of how productive or unproductive they might want to be with their own personal and professional careers. And so I would say there's different levels, and you find those levels over time, and you can always bring up those levels and add more information over time. But I think starting with the family history, the family values, sacrifices, and goals is a great starting point, followed by an introduction into the estate plan and the roles and responsibilities, followed then by how wealth might transfer, right, and the expectations, then followed by the valuation aspect of it. And again, that might be over a series of years or even a potential a decade or two before you get to that degree of confidence.
Great. I know we're getting close to time here, so I'm going to move us along to the next question. And you guys did kind of hit on this a bit throughout the presentation, but what kind of team will my children have around them at Baird to help them with future needs? And then to give you an example, when their father and I pass and they need help with settling the estate, will this be something that Baird Trust can help with?
Yeah, Justine, just kind of quickly, you know, your children are going to have a full team. Scott put up that wheel that shows all of the different parts of planning that will be with your child, as well as your financial advisor. But with Baird Trust, there is an entire team that focuses on helping settle estates, and it's important to understand that people think that they are doing their family a favor by naming the surviving spouse or a child as the person to handle the administration of an estate. Know that even if that is whose name, Baird Trust is available to help support the person named to make sure that an estate is settled professionally, correctly, and sometimes to allow that personal representative to stand behind and use Baird Trust as a shield to say, look, this is what the document says, and this is how the estate has to be administered. So it is a complete team that remains in place. It's it's a deep team with a wide breadth of experience that'll make sure that your children and family are well attended to during the settlement of an estate.
Awesome, thank you. Bob, I know we have a couple slides on some additional information, so I'm going to kick it back to you to run us through the last couple slides, and then I will close us out.
Sure, thank you. And I'll be mindful of time. If you go to bairdwealth.com, you'll see that there's a video by our advanced tax specialist, Tim Steffens. It talks a lot about what we discussed today as it pertains to the sunset of the estate tax exemption. I suggest you listen to it. It's provide some great information. In addition, there's other great educational information available on the bairdwealth.com website. So I invite you to check it out. Also, for those who are more philanthropically inclined or interested to learn about philanthropy, Jonathan, I'll turn it over to you to talk about how Baird Trust is able to meet a client's philanthropic needs.
Yeah, and even from the bairdwealth.com or bairdtrust.com, you can go into all of our services, but particularly the team that I lead is the Charitable Solutions Group, and we work with families with private foundations, with Charitable Remainder Trust, Charitable Lead Trust, as well as nonprofit organizations. So we're always happy to have those conversations, working with your advisors and you to make sure that your goals are accomplished. So it's all about having those conversations early, bringing your advisor into the fold.
Awesome. Thank you all so much for your expertise today. Thank you everyone on the line for your time. We did get a few questions around the recording and the presentation, so that will be made available in about a week through your Baird financial advisor, so don't hesitate to reach out to them. I know too, you've all had a lot of questions, so please do engage with them on this conversation, and they will pull in the appropriate resources as necessary to discuss your specific situation. So thank you all so much for your time, and enjoy your afternoon.